Hello, everyone, and welcome this morning to our 2020 tax update on the CARES Act changes and our presidential candidates' proposals. My name is Mike Moffitt. I'm president of Cornerstone Financial Group. It's a company I started back in 1987 from the basement of my home on a old kitchen table with an old IBM computer, and as I'm sure most of you can relate to if you're that age, a dot matrix printer. It probably wasn't much more at the time than just a fancy typewriter. But I do want to mention that I noticed a lot of the folks on the presentation today have an ag background, and I think that's probably a little bit on purpose because some of the topics we'll be talking about today will have a little bit of an ag flavor to them. And definitely my background has been in agriculture. I grew up on a farm, still live on the family farm. So for those of you who have an ag background, I want to thank you for joining us today. There are some folks here who are business owners, some folks who are not business owners. Probably, I think Emma would agree, the early part of this presentation will be a little bit more tailored to the folks who do have a business and some of the effects of the CARE Act on those. The latter part of the presentation will be more geared to everyone else, well, actually everyone, as she's going to talk a little bit about our presidential candidates' proposals as we're getting very close to the election. So a little bit about Cornerstone Financial Group. We're one of the sponsors along with Eide Bailly today. Cornerstone was founded in 1987, and we've kind of evolved through the years, but one of the things that we've always believed in is the fact that education is the key to making good decisions, whether they be business decisions or investment decisions. We've always felt like education is very important. And our motto has always been to help wealth creators grow and preserve their legacy. And towards that end, we have put together here recently this Best Webinar series, which is an acronym for Business Enhancements, Strategies, and Tools. And we have realized early on that, there's a lot of factors that affect individuals, but businesses as well. Some of the external factors I've listed here on the screen. And as you notice, one of the keys is the one right in the middle, which is taxes. And that's kind of where Eide Bailly comes in here. We have, as a result of this webinar series, put together what we call a virtual family office. And in understanding the fact that we can't be all things to all people, we do want to put together what we call a team that can help them with whatever their issues might be. I've listed a few of them on the screen here. It's by no means a comprehensive list of everything. But the tax specialist obviously is the one that we're going to be dealing with today. And Emma is going to be the person that's going to be talking about that. So a little bit about Emma and Eide Bailly. Eide Bailly is, I think now, probably in the top 20 in CPA firms in the country. Okay. And I did a little research on them on the website, and I see that they are over 100 years old, so they've been around a long time. And one of the things that we liked about it, and one of the reasons we wanted to partner with them, is because they have a deep bench, I guess would be a good way to put it. It's not a sole practitioner sort of business. It's one that if you have a lot of different issues, there's probably somebody at Eide Bailly that can help with that. Emma herself has been a CPA for over 5 years. I think you're a UNI grad, correct?
I am, yes.
Hey, Panthers.
That's right.
Serving a wide variety of industries, probably a little bit more of a focus on ag-based and financial institutions. One of the things I like about her and Eide Bailly is that they like to collaborate to find solutions for folks, not just scorekeepers at the end of the year when it's time to do taxes, but also coming up with ways to legally, reduce those taxes and build wealth. So a couple of housekeeping things before we get going here. This is a webinar that is in listen-only mode. That doesn't mean you can't ask questions. If you want to do that, you'll have to use the chat function. One of the other folks that's on with us here today is Michelle Beyer, and she's with Cornerstone Financial Group. She'll be monitoring that chat function. So feel free to ask any questions. I would probably send those questions to the folks who are the panelists, because if you send it to everyone, then obviously everyone knows who you are and knows what question you're asking. Not to imply that anybody would ask a dumb question, because I'm sure there are no such things.
No.
But I think that's just it. There's always a chance, I suppose, that something will happen during the webinar. We're in different locations, so if I lose internet, Emma can keep going. If Emma loses the internet, we're probably all screwed, because there's no way I can put on her part of the presentation. But we are recording it. So if something happens along the way, we'll send you a recording. If you happen to lose internet as an attendee, let's see if there's anything else. Oh, recorded. Yeah, we'll probably be sending that out. I would say, Michelle, probably take us a few days to get that recording ready to go out. So, but I think she's muted. She's just monitoring right now. But I think that's it. So without any further ado, I'll turn it over to Emma.
Well, thank you, Mike, for that introduction, and thank you everyone for attending today. So I'll be going over, as Mike said, the CARES Act changes, specifically focusing on the tax changes that were in the CARES Act. And as I'm sure you are all aware, there was a lot of stuff packed into that CARES Act, including the economic impact payments, the Paycheck Protection Program, expanded unemployment benefits, and assistance for state and local governments. But like I said, I'll be mostly covering the major tax provisions today. So the first one that I wanted to talk about is a very taxpayer-friendly modifications to the net operating loss rules. When they passed the Tax Cuts and Jobs Act back in 2017, they took away net operating loss carrybacks. So you were previously able to carry those back to prior years. And what the TCJA was made them, or allowed NOLs to be carried forward indefinitely. And they could also only be used to offset 80% of taxable income. But what the CARES Act did is allowed for a 5-year carryback of net operating losses for tax years 2018, 2019, and 2020. So it basically delayed the NOL rules in the TCJA until 2021. The most important part of this is that it allows these losses to be carried back to pre-Tax Cuts and Jobs Act years when the tax rates were slightly higher, especially for C corporations. We're talking about a 35% rate 3 years ago or longer, and today it's a 21% tax rate. So this can allow for permanent tax savings, a kind of recoup of those taxes that you paid 5 years ago that you thought you would never see again. So, and in addition, these net operating losses can offset 100% of taxable income rather than the 80% in the Tax Cuts and Jobs Act. For tax years beginning in 2021, NOL carry forwards from 2018-2019 can only be used to offset 80% of taxable income. So just some procedural aspects. How do you file these net operating loss carrybacks? So you can elect to carry them forward. So if you do not want to carry them back, say you just don't want to deal with it, or maybe you want to kind of hedge risk of tax rates going up in the future, and you have these NOLs from 2018 to 2020 that you really prefer to use in the future, you do have the option to do that. You will want to elect that when you file your 2020 tax return. So if you've already filed 2019, which almost everyone has, maybe except for those of you with derecho relief, you're going to want to get that filed with your 2020 tax return. Otherwise, if you don't elect to carry them forward, you have to carry them back to the full 5 years. So for instance, you can't carry back a 2018 NOL to just 2017. You have to carry it back first to 2013, 2014, 2015, etc., until the full NOL is used up. This is also, the NOL carryback rules are also available for fiscal year filers. If you are in a tax year that straddles 2017 or it straddles 2018, 12/31/2018, no, sorry, 12/31/2017. So your fiscal year began in 2017 and ended in 2018. That year you're eligible for a 2-year carryback, whereas the next year, where your tax year starts in 2018 and ends in 2019, you're eligible for the full 5-year carryback. A couple due dates and deadlines for this. So you have 2 options for claiming these net operating loss carrybacks. The first one is to file what's called a quick refund claim. And these are filed for C corporations on a Form 1139 and for individual taxpayers on a Form 1045. And these are, these enable you to get your money a little bit quicker. And so the IRS has to act on these within 90 days. And what the IRS did this year was opened up a fax line, so you can just fax the forms to them. And I think they did this because they're so backed up with mail because of the shutdown due to COVID. So as far as I know, they still haven't climbed out of that pile of mail. So definitely want to fax these if you're able to. So for 2018 claims, the due date to fax the forms was 7/15, so July 15th. However, you do have an option to still claim net operating loss carrybacks on your from 2018 by amending your tax return rather than filing these quick refund claims. So the refund will come to you quite a bit slower, to be honest, than the quick refund would. But you still have an option to get that money back. If you have an NOL in 2019, you're going to want to get those quick refund claims filed by 12/31 of this year. Just a quick note too is that in the proposed HEROES Act by the House Democrats, they would have retroactively revoked the ability to carry back losses. So this got a lot of bad press, saying that this NOL carryback rule was basically allowing millionaires to go back and claim refunds that they really weren't entitled to, which is obviously incorrect because you are entitled to this. It's written in the law. So I must have been, sorry, I thought I had an example, but I think it's coming up after these slides. So the next important provision in the CARES Act was a fix for what's known as qualified improvement property. So what is qualified improvement property? It is an interior improvement, non-structural improvement to a building, which used to be under old law, that used to be considered part of the building. So it would, for tax purposes, the wiring, the non-structural walls, the plumbing in those non-structural areas would all be considered 39-year property for tax, which is a very long life, likely longer than you would use it, and it subject to straight line depreciation method. So you'd get a very low amount of depreciation annually. And when they passed the Tax Cuts and Jobs Act, they meant to write in that qualified improvement property would have a slower life or a shorter life for tax, 15-year life rather than 39-year, but they basically forgot when they were drafting the legislation and made it 39-year property. And that made it not eligible for bonus depreciation. So then we have to talk about, okay, what is bonus depreciation? So there's 2 different types of immediate expensing when we're talking about depreciation. The first is Section 179, which I think is a little bit better known than bonus depreciation. However, Section 179 is subject to income limitations, and it's also subject to the amount of property that you've purchased for the year. So if you purchase too much property, you don't get to take 179 depreciation, as well as if passive investors usually aren't eligible to claim Section 179 depreciation. However, bonus depreciation is taken at the business level, and it is 100% expensing of 15-year and lower property. So all computer equipment, software, any manufacturing equipment, and then now the qualified improvement property. So basically what CARES Act did is what happens to the depreciation that we could have claimed on this qualified improvement property from 2017 to when they drafted the legislation in the CARES Act in 2020. And so now you can go back and basically fix it and claim all of that depreciation that you may have missed out on in prior years. And again, there's a couple different ways you can do this. So it's actually, I'm going to skip this. It's actually really taxpayer friendly because you can structure when you take this depreciation to kind of manipulate or figure out when the best tax time to take the depreciation is. So I have a couple examples of this. So let's say that the taxpayer has filed their 2019 tax return, again, like most people have, the taxpayer will need to file what's called a Form 3115 to correct any prior depreciation claimed. And a 3115 is just, it basically tells the IRS we are changing our method of accounting on these assets to correct an issue on prior year returns, and we're going to catch up all of our depreciation. So the 3115 can either be filed with an amended 2019 return, or the Form 3115 can be filed with a 2020 tax return. So how this would work, so let's talk about let's say our taxpayer is a C corporation and they placed in service qualified improvement property totaling $500,000 on their 2018 tax return. So let's assume that the taxpayer's taxable income for 2019 is $500,000, but they're projecting no taxable income for 2020 because of the downturn in the economy. So let's also assume that 5 years ago in 2015, the taxpayer had $500,000 of taxable income. Remember, again, at that pre-TCJA rate. So what are the tax savings of correcting the qualified improvement property on the 2019 versus the 2020 tax return? So if we file the Form 3115, or filed, I guess at this point, with the 2019 tax return, we wiped out all our taxable income. We've saved the taxpayer $105,000. Everything we're all happy, right? We saved $105,000. But if we file the Form 3115 with 2020, we create an NOL of $500,000, which we can then carry back to 2015, which, remember, 2015 is at the 35% rate. And now we have a tax savings of $175,000. And that's a permanent tax savings, one that we would never get back otherwise, of $70,000. So it's a lot better to put on your tax planning hat and say, let's wait and claim this in 2020 and carry it back to a pre-TCJA tax year and save $70,000 permanent tax savings. So the next one is that, something else that was included in the Tax Cuts and Jobs Act was the business interest expense limitation. And this basically reduced the amount of business interest that you are eligible to claim on your tax return if your interest expense is a lot higher than your adjusted taxable income. So, and the adjusted taxable income for at least for 2018 through, I think through 2025, but it might be a little bit shorter than that. Your adjusted taxable income is basically your taxable income plus any depreciation or amortization claimed, plus any NOL claimed, and a couple other things to get to the adjusted taxable income amount. And that's where you calculate the amount of your interest expense limitation. So it was 30% of that adjustable taxable income limitation, but they upped it to 50%. So this is helpful for leveraged businesses, especially if the interest expense limitation was kind of a surprise to you when they came out with the TCJA. And in addition to the higher limitation, they're allowing taxpayers to elect to use 2019 ATI for your 2020 tax return. So 2019 was a relatively good year for businesses, and 2020 is not looking like a very good year. So this is really taxpayer friendly because they're allowing them to use the higher income year to calculate how much interest expense they can take in 2020. And the next thing is just a note if you are invested in any partnerships or your business is organized as a partnership. So they treat S corporations and partnerships differently for this rule. And it's actually a little bit worse for a partner because there's some specific rules, first of all, where it's still 30% of ATI for your business interest limitation. And in addition, there's some complications at the partner level. So first, they disallow the interest expense at the partnership level, but they still flow through the other 50% to the partner. So this can basically result in 2020 as $50 is treated as deductible by the partner in 2020, but the other $50 is treated as excess business interest, which is tied to the partnership. One item that I wanted to note for tax planning purposes on this interest expense limitation is to, if you're taxed as a cash basis corporation or a cash basis taxpayer for tax purposes, you may want to consider paying down some debt at the end of the year to bring more of that interest expense into 2020 to get that higher deduction when you're not quite as limited, because it's going to go back to that 30% rule for 2021.
Now, is that a for sure, Emma, or does it just kind of depend on how COVID plays out?
Since we're not seeing any, I mean, the Senate's already adjourned until after the election, and I think it would be I think the probability is very low that we would see any more legislation for in this year. So I'd say it's pretty much for sure that it's going to go back to the 30% for 2021. But again, anything is possible. Mm-hmm. And it also kind of depends. So that question also goes into if the Senate and the House, if the House stays in Democratic control and the Senate flips to Democratic control and the White House also switches, could they pass something in 2021 that would be effective for 2021? And I kind of talked to a partner here in this office, Joe Christon, if you know him, and he felt like it was a 60-40 chance that they would move it into 2022 rather than 2021 just due to the economic downturn. And he watches politics probably a little bit closer than I do, so I trust his judgment over my own, but yeah. All right, so moving on, this is going to affect small business owners on your individual returns. So this is Another item that was in the TCJA that wasn't quite as taxpayer friendly as they're making it in the CARES Act. So a 461L business loss limitation only allows for business losses of $500,000 on joint returns. And a business loss is a Schedule C, a Schedule F, income from pass-throughs, so as corporations or partnerships that you're actively in the business of. And the CARES Act updated a couple rules on it. So they made the 461L effective in 2021. So they delayed it. So I had a couple different taxpayers who had business losses in 2018 that were limited to the $500,000. So what we had to do is go back and amend 2018 to take out 461L, allow all of the business losses, which then creates a net operating loss, which, as I talked about earlier, you can carry back the 5 years. So that's kind of the process for getting back these 461L losses. One thing that they included in the CARES Act that kind of updated maybe a glitch that they didn't want in the original law is that they are saying that wages are no longer treated as business income. So if I had a $750,000 business loss, I could take the $500,000 of the amount that's allowable for my business loss. But then let's say I also take a W-2 from another business that I own, and it's $250,000 of W-2 income. I could also take the $250,000 loss, but when they updated it in the CARES Act, they took that away. So a little bit less taxpayer friendly there, but there is an opportunity to go back and claim those for 2018 and 2019. And then just a couple of small things that were included in the CARES Act as well. And these are more related to the individual taxpayers. So charitable contributions, this is a small one. They're allowing up to $300 as an above the line deduction without regard to itemization. So this is something that I expect to see on almost every tax return. Just there isn't a lot of substantiation requirements to it. And then one other thing that I think for those who are feeling generous this year, maybe they have not seen or felt as much of the economic downturn as others, they lifted the 50% limitation for itemizing individuals. So they suspended it for 2020. So you are able to deduct up to 100% of your adjusted gross income for charitable contributions for 2020. One caveat with this is that you cannot contribute the charitable contributions to a donor advised fund. It has to be a direct cash contribution to a 501c3. And then a special rule on retirement funds used by taxpayers affected by COVID. So they are waiving the 10% early withdrawal penalty for distributions up to $100,000. And you are able to spread that income over the next 3 years. And you have to be either yourself diagnosed with COVID, your spouse or your dependent diagnosed, or you have to be adversely financially affected by COVID to be eligible to claim the waiver. So maybe your spouse was laid off, or maybe they couldn't work quite as much. They had to go down to half-time because your childcare wasn't open or something like that. That would make you qualify.
I talked a little about this yesterday, Emma, and I had mentioned the case of somebody who has a pattern of taking money out over the past few years, and I asked whether or not she could use something like this. And I think the pattern kind of made a difference, didn't you feel like? I mean, as far as her ability to maybe use this special rule?
Yeah, so I actually got to thinking about this. And one thing that I thought that maybe you could pitch is that, you know, maybe this is the year that she wanted to not be so underemployed, right? Maybe this is the year that she was out and she was looking for a job, but she just couldn't find one because of COVID. So, you know, I think you could make an argument that she was underemployed because of COVID, because the job that she maybe wanted to do, or the job that would pay what she wanted to pay, wasn't out there. So I think that's an argument you could make, is that she was underemployed because of COVID. You know, I would make sure that there's some vein of truth to that. I wouldn't just say that just because of this rule. But I think there's something you can do there to get out of this 10% withdrawal penalty. And I do want to go through an example of how this works on your actual tax return. So if, let's say I was adversely financially impacted by COVID, so I took a distribution out of my IRA, and I should mention this qualify, 401ks, 403bs, and IRAs all qualify for this. So let's say I took a $9,000 distribution out of my traditional IRA, which normally would all be taxable to me in 2020, and I am under 59.5, so I would usually incur the 10% penalty. So I have no 10% penalty, and my income is taxable ratably over the next 3 years. So $3,000 would be taxable to me in 2020, then another $3,000 in 2021, and another $3,000 in 2022. So let's say next year I have the extra cash. I really want to just recontribute this back into my IRA. So I filed my 2020 return showing a $3,000 of income. When I go to file my 2020 return, I recontributed $6,000 back into my IRA. So I won't have any income on my 2021 tax return, because I would take in income the $3,000, and then I would show the $3,000 as recontributed in a trustee to trustee transaction, similar to how a rollover would work. What I would have to do to get my taxes back on the income that I claimed on my 2020 return is I would need to file an amended return. So that would recoup my taxes, and then I would do the same thing in 2022. When I file my return, I would just recontribute the $3,000 back into my IRA, so that I didn't have to pick up that income in 2022.
I notice your bottom point there, the waiver of the minimum distribution rules. We get questions on that from a number of people, because some of the custodians we use, because of this, have not sent out the normal RMD, because it isn't required, so they don't send it out. Some do, some don't. It is a little bit of a head scratcher, though, for me, as to why that has anything to do with COVID, but maybe you have an idea on why they waive that RMD rule.
You know, I actually am not sure. I think because for a lot of people who don't need it, they do see it as a hassle. But to be honest, I'm not entirely sure why they passed it that way, and I haven't actually done any research on why. I don't know if I'm trying to think, maybe it's to keep more money in the markets or something, but I'm not sure. That's actually a great question. All right, so probably what most of you have been waiting for, the presidential candidates' tax proposals. And so how I've structured this is I start by talking about the current law, and then I talk about what Trump has either proposed, or usually he says he just wants to extend the current tax law into farther years. And then I talk about what Biden is proposing. So for individual tax rates, there's currently 7 brackets, with the highest of those being 37%. And that is set to expire in 2025. Trump has proposed some sort of 10% middle class tax cut, you know, middle class being the buzzword. And we don't know exactly what that would look like. but he has also said that he would like to extend the current rates beyond the 2025 expiration date. Biden has proposed increasing the top rate back to pre-TCJA, which was 39.6%. But he has also said he would not increase the tax rates for incomes below 400,000.
Now, did he say anything about where those brackets hit? Not the top ones, but I'm just talking there because there's a pretty good gap. You have a couple of lower rates and a couple of higher rates right now. So
yeah, so I think right now the top rate starts at, I think, $1 million, somewhere around $1 million of income. And I get the feeling that Biden's would be, the top rate would start at 400,000. Just because he's only proposing increasing the top rate, but he's also not proposing any increases for anyone below 400,000. So I think what he's saying is, since that top rate starts a lot later in the current bracket system, I think he is proposing an increase at that $400,000 level, which would be a significant increase to those who are currently at the $400,000 level, because that's probably at right now 35%. I'd have to look at my bracket chart. I unfortunately don't memorize where all of them start. But yeah. So corporate tax rates, again, currently 21%. President Trump has proposed no changes to that. Former Vice President Biden has talked about increasing that to 28%. And in addition, he would like to charge a 15% minimum book tax on companies with more than $100 million in book income. So this isn't probably not going to apply to too many Iowa taxpayers, but it certainly would apply to somebody like Amazon. I think that's really what this is aimed at, is those companies who, make substantial amounts of profits, but don't pay any taxes because of the capital investments and everything that they're making. They're building warehouses everywhere. I mean, if you just look at Des Moines, they've got a warehouse in Bondurant and a warehouse in Grimes, and so yeah, Biden has proposed that 15% minimum book tax to kind of get them out of their tax loopholes, if I'm sure that's what he would say. So capital gain rates. So this one is, to me, it feels pretty unfair to small business owners, and especially unfair to farmers who are transitioning their family business, their family farm to the next generation. So currently the top rate is 20% for capital gains. And net investment income tax also applies to married filing joint over 250,000. That's the 3.8%. The 3.8% basically Obamacare tax that they added basically to pay for Obamacare, which is currently in contention with the Supreme Court. And now that there's an additional justice, that's why they're talking about in the news a lot that the Affordable Care Act may be overturned as non-constitutional or unconstitutional. So that net investment income tax may or may not go away in the next, whenever they vote on it, basically. For those taxpayers that are in and below the 12% bracket, they pay 0% on long-term capital gains, and taxpayers with income greater than the 12% and the top rate, so up to $1 million, only pay a 15% long-term capital gain rate. So President Trump would like to extend those provisions past 2025, and this one's really kind of a kick in the teeth. Biden would repeal capital gains and dividend rates for households earning more than $1 million. So I wouldn't say that most of us make more than $1 million every single year, but when we may make over $1 million is the year when we sell our family business, when we sell our small business, when we sell our family farm. You're looking at significant income in those years. And I think this is very punishing to those people who, in that 1 year where they've made that money, to be taxed at such a high rate, because again, the top rate would be 39.6%. So, and then if you're just an investor in this, you have to pay the 3.8% net investment income tax on top of that.
So Emma, what are you saying, that the capital gains rates under that proposal would be the same as ordinary income rates?
Correct. Mm-hmm.
So up to 39.6 potentially.
Yep, correct. So I was kind of thinking through, what can you do to kind of mitigate these taxes? You know, if you are looking at a large gain on farmland or on a small business. And one thing, you could structure the sale so that, and you can do this either by selling pieces, like, so for instance, if you're organized as an S corporation, maybe you sell some stock each year that will keep you below the $1 million income. And then you could hopefully still get that preferential long-term capital gain rate. Or let's say you're selling your farmland to your son, you could structure the transaction so that it's a installment sale. So, you know, you set up payments every year, and then you only have to recognize income on the payments received for that year. So that's one way that, you know, just thinking about what your transition plan is for your business or your farm is going to be really important if something like this were to be passed. The qualified business income deduction. So this was passed with the TCJA again. It's the 20% deduction allowed on business income, and this was to offset the drop in C corporation rates. So Trump has proposed no changes to this. Vice President Biden, or former Vice President Biden, has proposed a phase out of deduction for taxpayers making more than $400,000. And so again, combined with the rate increase, pretty unfavorable for those over that $400,000 income. Depreciation. So I talked about 179 in bonus depreciation. Some of those rules are set to expire in 2025. So President Trump has proposed extending those beyond the 2025 date. Biden would reverse those immediate expensing. So I don't know if that means a total repeal of 179 in bonus depreciation, but it definitely means taking away the amounts that are currently allowed. So
what is that on the 179 right now?
They update it every year. I think it started at, this is embarrassing, I should know this. I think it started at 500,000, but I'd have to look it up. And so it might be.
Put you on the spot.
No, that's okay. That's okay. I should know it. I'm just blanking on the amount right now.
It's fairly high at the moment, I think.
Yeah, it is. It's it's a pretty large amount. You'd have to invest a lot, like basically put up a whole nother building to get over it, or buy a lot of equipment. Oh, yeah. Okay, so wealth tax. This was more talked about by candidates a little bit farther on the left spectrum than Joe Biden. So I believe Elizabeth Warren and Bernie Sanders were pitching some sort of wealth tax. that would basically be a tax on the assets of somebody who's over a certain threshold. The threshold's pretty high, but one problem that I have with it is that it's just impossible to calculate. How do you calculate somebody's wealth, because it's always changing. And so no current proposals by either of the candidates for any sort of wealth tax. Estate taxes. Here's another big issue in this election. So currently there is a 40% estate tax. However, that estate tax doesn't start until you have an estate which is in excess of $11.7 million. And that is per spouse. So both the husband and the wife receive an $11.7 million exemption. One thing that I'll mention with this is that we also are living in a world with something called portability, which means that if the husband were to pass away, the $11.7 million from the husband would also go to the wife. So a total estate of over $23 million would be a non-taxable estate in today's tax environment. There's also something called a death step-up in basis. And what this is if I were to own a piece of farmland that I purchased back in 1970, and let's just say I purchased it for $50,000, and today it's now worth $100,000, or it's now worth $1 million. When I pass away, the value of that farmland is stepped up to the fair market value as of my date of death. So it would be stepped up to the $1 million basis, and that $1 million of fair market value in that land is what gets included in the estate. Currently, it's set to revert back to the $5 million in 2025, but again, President Trump would like to extend that. Biden has proposed eliminating the step up in basis rule. And this could look like a couple different things. The first way it could look is that there's a tax on the unrealized appreciation at death, and that's immediate. So it that $950,000 difference in my cost basis and my fair market value of my land when I pass away would be taxed immediately. And I'm not sure if that would be included on my final 1040, my final individual tax return, or if it's on somehow tied in with the estate tax return. I'm not really sure. The second way that this could be applied is by applying my carryover basis, my $50,000 basis in my $1 million of farmland would be applied to whoever inherits the farmland. So my heir would receive that land at a $50,000 basis. And then if they were to sell it, they would pay the capital gains tax on it. Then the question is, if in either of these situations, what's included in the estate? And we just don't know. It's not known to us at this time, which if the basis would be included in the estate or the fair market value.
That would make a big difference.
It does. It does make a huge difference. So yeah, I'm assuming there would not be double taxation on it, but it's possible. And in addition, Biden has proposed lowering the exclusion amount to $3.5 million, making an estate of $7 million for a couple taxable. So this year is the year that if you have an estate between the $7 million and the $23 million, the $7 million proposed by Biden and the 23 that the law currently has today, you should be talking to your attorney about how can we get that difference out of my estate, because you don't want to be ending up with a 45% tax on that estate. And the reason why you want to get it out of your estate right now is because the IRS has come out and said there will be no clawback at that exemption if the exclusion drops in future years. So if I have an estate of 15 million and I transfer 8 million out of my estate to get down to that 7 million, the IRS can never come back and say, hey, you moved that 8 million out of your estate, we're now going to tax it. They've said they're not going to do that.
So what are some of the options? Maybe like an irrevocable trust or something like that?
Yeah.
Yeah.
Mm-hmm. Yep, exactly. So you're looking at an irrevocable trust or gifting it out to your heirs or to whoever you want to inherit it.
Either way, though, you've still got the low basis.
Correct. Mm-hmm. Unfortunately, yeah, you don't get both. You don't get the step up and the increased exclusion unless you were to pass away right now, which is always a question mark. So, yeah. Yeah,
that's probably not part of my planning, is to pass away right away.
It's not part of most people's. So, and I'll try to run through this, the last few things relatively quickly, just in the interest of time. But child incentives, currently there's a $2,000 child tax credit, and Trump would extend that. Biden would expand the dependent care credit up to $8,000 with a max of $16,000 for 2 or more children. This is probably a needed update given the cost of childcare, but it is an expensive one. And he has said that I believe that every family under the $400,000 income would receive the full credit. Some additional credits and deductions. So currently there's a $10,000 limit on the amount of state and local taxes that you can claim as itemized deductions. Trump would keep that and extend it. Biden has proposed ending that SALT cap, but capping itemized deductions at 28%. There's currently not a cap on itemized deductions. So this would be detrimental, especially to those who give a decent amount in charitable contributions. Student loans. So currently student loan forgiveness is includable in taxable income. However, Biden has proposed canceling tax-free borrowers who are on an income-based repayment plan as long as they make timely payments for 20 years, which I think this is already, this already exists. It's just not canceled tax-free. It's taxable at the time, but the cancellation already exists. So nothing super huge here. This is another question mark that I'm not really a fan of. So a transaction tax, Biden has proposed supporting a transaction tax. However, we don't know how much that transaction tax might be, or if it starts at a certain threshold of transactions. Does it apply to 401ks or other tax deferred accounts? We're not sure. So just a general blanket support on that's a little bit concerning. Social Security tax, I don't see a lot changing with this. However, there is currently a cap on the amount of FICA charged to employees making $137,000 or more. They stop paying FICA on any wage beyond that. Biden has proposed lifting that cap for earners who make more than $400,000. And President Trump also waived FICA and FICA, I believe it was just FICA, for the remainder of 2020. However, most employers did not start doing that because they have to start paying it back as of 1/1 of 2021. This real estate changes are for like-kind exchanges. You're able to exchange, let's say, a building for a building, And as long as you follow all of the rules of the like-kind exchange, you're able to defer any tax gain or loss on that building if you exchange it for basically another piece of property. And Biden would eliminate this he would eliminate like-kind exchanges for real property. So these are just a few, some analyses of both former Vice President Biden's tax proposals, as well as President Trump's Tax Cuts and Jobs Act passage. So these are provided by the Tax Foundation. I thought it was a center of the road kind of way to evaluate the two proposals. So in general, Joe Biden would increase rates, but they would really only be on individuals who earn more than $400,000. It would, depending on which model you look at, you're looking at a 3.2 to $3.8 trillion increase in tax revenue. It would cause a rough reduction in GDP of about 1.5% over the long term, which is actually a pretty big number. And the Biden tax plan would lead to 7.8% less after-tax income for the top 1%, 1.1% lower after-tax income for the top 5%, and around 0.6% for basically everyone else. And again, where I think the plan fails is for those taxpayers who end up in those top brackets for just 1 or 2 tax years of their entire lives. So. The impact of the Tax Cuts and Jobs Act, and this is a 10-year outlook, so it would reduce federal revenues by about $1.8 trillion. The economy should be about 2% larger after 10 years. Result in an increase in after-tax income for all taxpayers, which I think has been kind of misconstrued by a lot of people. I think a lot of lower income earners thought that their taxable income their tax went up when the TCJA was enacted, but really it didn't. Their withholding went down, which caused them to owe more tax at the end of the year, but their overall tax paid was lower. So the larger economy will result in higher after-tax incomes. However, the economic impact of the Tax Cuts and Jobs Act will be modest in the first few years, but increase as economic effects phase in over time. So we really haven't, since the Tax Cuts and Jobs Act, I believe, has been in effect for just 2 tax years so far, 2020 being the second tax year, we don't really see the full effect of it until, a few years down the road. So that is all I have. I haven't seen any questions come through, but I welcome them for sure.
While we're waiting to see if there are any questions, for some of us who might not know, what is the major difference between the QBI deduction and the like-kind exchange?
So those, I think, are 2 different things. The QBI deduction is, so if let's say I have a farm and I'm active in my farm business, and I make $100,000 in taxable income in that farm, I get a 20% basically fake deduction off of that $100,000. So, and it's subject to certain limitations. You have to, depending on your income level, you have to have wages paid, and you have to have an investment in property. So, which does not include land. So maybe my farm example might not be good here, but let's say all I make is $100,000. that would be below the income limits where I have to apply the wage limitation or the asset limitation. So I would have $100,000 of income, and that's what I compute my 20% deduction on. So then after my 20% deduction, my taxable income is now $80,000. For the like-kind exchange, that one, so typically when I sell a building, let's say I own a building I bought for $80,000. I haven't done any depreciating on it. And I sell it in 5 years for $100,000. I would give my $100,000 of proceeds to a trustee, and then I would tell them, okay, I'm going to purchase this other building for $100,000. And the trustee would then pay for the building. And then my basis in that new building is $80,000. But I really have a gain on my original building of $20,000, but I've deferred it by taking my original basis in the new building.
Okay, very good. Thank you, Emma.
Mm-hmm.
Lots of good information there. Michelle, do we have any questions? I didn't see any, I don't think.
I'm not seeing any questions coming in.
Okay, very good. Couple things before we leave here today. Our next upcoming webinar, I think I'm really excited about this. It definitely is not going to be for everybody, and probably some of the folks on the call, you won't find this of use, but there'll be some that might. It's rethinking your enterprise risk management.
I messed up.
Yeah, that's okay. I can get back to it.
Okay.
And strategies to reduce that 6 to 7 figure insurance premiums that you might be paying, whether it be health insurance, workers' comp, property casualty insurance. The speaker is going to be Wes Sirk. He's president of Risk Management Advisors in California, and he's also a multiple-time author on this very topic. I think it's going to be great. It's going to be on Tuesday, November 17th. The time is 11 a.m. I don't think, Michelle, we have that up on the website yet as far as registering, but there will be shortly, I think, and anybody who's been on this webinar today will get an email invite as well. So looking really forward to that again on November 17th. Just one last thing. We talked about a little bit last time on our mergers and acquisitions webinar that we had. We did a study of business owners through the Exit Planning Institute a while back, and they found that 83% of the businesses thought a transition strategy was important, but 62% were paying little or no attention to an exit plan. Of the 83%, almost half of them had done no planning at all, and 71% had no written company transition plan. Well, that was really important, I thought, when we were talking about mergers and acquisitions, and those folks that might be getting close to it. But, you know, tax planning, if nothing else, it should make your company more valuable. You know, when you start thinking about doing all the things that add value to your business, tax planning comes right up there towards the top. And so I think the topics that we talked about today and the strategies that you could probably get by working with somebody, whether it be your CPA if they're doing proactive planning, or somebody like Emma at Eide Bailey, is really critical. So I'd encourage you to do that planning. And if you're not quite sure exactly where you are as far as how ready you are, maybe for a succession event, I'd encourage you to go to our website, cfgiowa.com. There's a button towards the bottom of the home page, excuse me. It says pre-score on it. And pre-score basically will take you through a series of questions designed to give you an idea really of how ready you are to exit your business with what I call without regret. In other words, being well prepared and getting a good buyer or getting a good transition plan put together. I'd encourage you to do that, sign up for that. If you take the pre-score, we'll send you out a white paper on our exit checklist. So I think that's about it. If anybody has any questions after the webinar you want to touch base with us on, feel free to give us a call on the 800 number. We'd be glad to help you with your strategic planning for your business. With that, I think that ends the webinar today, and I want to thank everybody for joining us. Have a great day.